Everybody, my friends. Today it will be my 32nd lecture series on the same topic, capital market, part 4. So we have gone through some of the very important areas of the capital market from part 1 to part 3, where we have understand that what do you mean by capital market, what are the various components of the financial market, how the capital market is related with money market, how the government actually reacts on the capital market, and what are the regulatory agencies throughout the globe on the capital market, not in the Indian context but on the global context. For example, the USA was the first country to have got the idea of introducing the capitalist economy. So the capital market comes, where the company has got a free hand in order to get the invitation of shares from the public. And there are very nuances, like how the capital market has got the relationship with the money market, how the capital market has got a relationship with the primary market, and what it is relationship with the secondary market. Secondary market or the market trading is very important to understand, because we always see in our earlier times in 90s or to 2000 that there are lots of terminals across the stock exchanges, whether it is in our country like Bombay Stock Exchange or National Stock Exchange NEC, or if you talk about the New York Stock Exchange or Shanghai Stock Exchange or Tokyo Stock Exchange or Hong Kong Stock Exchange or Dubai Stock Exchange or the London Stock Exchange, or we all know as FTSE. So the important component of the capital market is the secondary market. Primary market was the area where we have gone through that how the IPO are being issued on the primary market, and the company are being are inviting from the public, and in the form of issue of IPO, in the form of further the public issue of shares like private placement. There are many modes of getting the money from the public. We will go into the detail that how the primary market works in our separate series, where we will study about the details of IPO and the primary market. But now we will get a little bit overview of the secondary market trading, the trading terminal. Now, in most capital market transaction that actually takes place on the secondary market. Now, on the primary market, each security can be sold by once, and the process to create the batches of a new shares or bonds is often lengthy due to the regulatory requirements. Now, on the secondary market, there is no limit to the number of the times the security can be traded, and the process is usually very quick. Like the transactions on the secondary market do not directly raise the finance, but they do it make it easier for the companies and the government to raise the finance on the primary market, as the investors know that if they want to get their money back quickly, if they want to and they usually be able to resell their securities. Sometimes, however, secondary market transactions can have a negative effect on the primary borrowers. For example, if a large proportion of the investors try to sell their bonds, this can push up the yields for the future issues from the same entity. An extreme example occurred shortly after the Bill Clinton, which began its first term as the President of the United States. Clinton was forced to abandon some of the spending increases that he had promised in his election campaign due to the pressure from the bond market. And this was a very typical and a very critical scenario where the president has to cut down his expenses with the pressure from the bond market. Now, the following the 2008 financial crisis. This is the area where all the stock markets, all the financial markets, all the global markets, all the financial markets, all the components of the financial market, even the entire finance of the world came to a halt. 2008 financial crisis, after the depression in 1930s, it was one of the serious crises which took place across the globe, including the US, was hampered regarding the emergence of the crisis that happened at that time, and the introduction of the quantitative easing further reduced the ability of the private actors to push up the yields of the government bonds, at least for the countries with a central bank able to engage in substantial open market operations. Now, central bank is also, like our Reserve Bank of India, is also engaged in the open market operations. They have got the being a regulator, they can interfere in the stock market regulations and can put a kind of a equilibrium or a pressure on the stock exchange and the private players to hold the rally or the bullish part. Now, a variety of different players are active in the secondary market. First one is the individual investors. Who are individual investors? Like us. Individual investors account for a small amount of proportion of trading. We as individual investors may look as of the voluminous in nature, but the amount of investment that the retail investors or the individual investors made is very much less than the institutional investors, because the individual investors to their share has slightly increased. In 20th century, it was mostly only a few wealthy individuals who could afford an account with a broker. But accounts are now much cheaper and accessible. We all know that because of the demat account open and because the shares are dematerialized, so it is called demat. Why it is called demat? The shares are called dematerialized. They are not in the physical form, and they are now accessible over the internet. Now you can log into any kind of a demat. You can open a demat account and you can start trading easily on the stock market. You can buy shares, you can sell shares, you can do anything. Like if you have, for example, the settlement may take place on the same day, but the settlement sometimes takes place in second days or third days. So there are numerous small traders who can actually buy and sell on the secondary market using the platforms. They are provided by the brokers, which are accessible via the web browsers. Now, when such an individual trades on the capital markets, it actually involves two-stage transaction. First, they place an order with their broker, then the broker executes the trade. Now, if the trade can be done on an exchange, the process will often be fully automated. If a dealer needs to be manually intervene, this will often mean a larger fee. Traders in investment banks will often make the deals on their bank's behalf, as well as executing the traders for their clients. Investment banks will often have a division or department called the capital market staff. Now we have got fund managers who actually holds the capacity in order, and they're competent in order to understand that where the funds of the investors will be invested on, and the various opportunities which are available for the primary and the secondary markets, and will advise the major clients accordingly. Now there are also kind of pension fund. In India, we have seen that our pension fund money is also being invested in the equity. We have gone through I have given a lecture series on the NPS, National Pension Scheme, where there is a composition of the equity wealth, there is a composition of the government securities wealth, and there is also a composition of the corporate bonds. So the pension sector is also now open for the equity and the stock market or the capital market. Now, the pension and the sovereign wealth funds tend to have a largest holdings, because though they tend to buy only the highest grade, safest types of bonds and the shares, some of them do not trade all that frequently. Their mode of investment is very safest because the money of the individual pensioners are involved in these cases. According to 2012 Financial Times article, hedge funds are increasingly making most of the short-term trades in large sections of the capital market, like the UK and the US stock exchange, which is making it harder for them to maintain them historically higher returns, as they're increasingly finding themselves trading with each other rather than obviously with less sophisticated investors. There are several ways to invest in the secondary market without directly buying the share and the bonds. A common method is called the invest in mutual funds. We will have a series in mutual funds also, that what is the pension fund, what is the mutual fund, what is the sovereign wealth funds, where you can invest in mutual funds, what are the areas that we need to look into the mutual funds or exchange traded fund, or called ETF, exchange traded funds. It is also possible to buy and sell the derivatives that are based on the secondary market, and one of the most common type of these is a contract for difference. These can provide a rapid profits, but can also cause buyers to lose the money rather than originally invested. Now the size. What is the size? For example, all the figures are given in the billion US dollars and are sourced to the IMF. There is no the universally standard for measuring for all these figures, and they are just estimates. They are estimates and predictions. A GDP column is introduced. Now there is always a method called forecasting and analysis. Somebody use a kind of a quantitative techniques, which is a little bit deeper in understanding, where you need to have the knowledge of the calculus and mathematics and quantitative techniques in order to derive the investment value and the risk which has been undertaken in that particular stock or the shares which has been invested. Now, another very important area is the capital control. How that capital control? The macroeconomic effect which you have the capital market always have a negative impact. It is a theory of allowing the market for the freedom in a win-win situation for all those involved investors are free to seek the maximum returns, and the countries can benefit from the investments, for example in financial crisis also. So the regulation and the capital control is very important. For example, the country like India employ capital control to ensure the citizens that the money is invested at home rather than abroad. So these are the areas where we need to understand that how there are many regulators which actually takes place, like for example the banks, the financial institutions, the companies are all engaged in the equity market through the various mediums of equity. There are various mediums of derivatives. We will also cover in our separate lecture series what is what are the various financial instruments. And there is also a very important role of our regulators like our Ministry of Finance, Government of India, our Security Exchange Board of India, through various regulations and guidelines, how they are going to control the capital market, and what is the role of the auditors and accountants in order to give a true and fair picture of the balance sheets and the profit and loss account or the income statement or the cash flow statement in their annual report, so that the investors get attracted to that particular company and they start investing. We all hope that the capital market will be well regulated, and I have tried my best in order to give you a kind of a small brief picture that how capital market works in this 4 lecture series. We will try to concentrate on various aspects of the capital market. What are the instruments of the capital market? What are the factors actually develop the money market? What are the macroeconomic and microeconomic factors in developing the financial market in our country also? So thank you very much for joining. We'll have our next series in these areas also coming soon. Thank you.